How do you get to a 0% tax bracket? A lot of people say it can't be done. You have books out there, The Power of Zero by David McKnight. You have a lot of folks talking about how do I do it? What is it done with? Well, one of the strategies you use is called the IUL, an Index Universal Life. So, folks, welcome to the channel. You're here with Earl, the Money Coach, and in the next few minutes, I'm going to break down how you could use life insurance, specifically your IUL, Index Universal Life, to get yourself to that 0% tax bracket. There's going to be pros, there's going to be cons, there's going to be ways you have to structure this. I want to kind of break it down so you could really get more information on this strategy. Because the biggest problem with your IULs, your Index Universal Life Insurance, is not a lot of agents know how to set it up correctly. So if you want to get down to a 0% tax bracket and understand using this approach with IULs and maybe infusing it with some of your Roth IRAs, having both of them kind of work together, you got to learn what it is and exactly how it works. So let's dive right into the IULs. What is a IUL, an Index Universal Life strategy? Well, understand this. Plain and simple, the Index Universal Life strategy is a type of permanent insurance. There's 4 types of permanent insurances out there, but it's one of the insurances that combines a death benefit with the cash value and gets an opportunity to grow based on the performance of the stock market, some of your S&P 500s and things like that. Now, the key of this strategy is tax-deferred growth on the cash value, and then the ability to take tax-free loans, not withdrawals. You're taking tax-free loans against the value of the cash during your retirement, but you have to structure it properly. If you don't structure your IULs, they could be a huge, huge mistake. The reason why, if it's not properly structured and you're not getting the maximum benefit of your IUL, it's not just about buying the policy, it's about having it designed properly. And the first thing people don't talk about, which gets on my nerves, is the cost of insurance. You need to understand you have to minimize the cost of insurance charges, and that reduces the money available. If you have more cost of insurance, it's going to eliminate the amount of money you have that's growing for you. So you want to keep the death benefit as low as possible while still meeting the policy requirements, but also it allows you to allocate more money towards the cash value growth. That's huge. Next, you have to overfund. There's what you call a minimum target and then a guideline annual, which is the max. Overfunding the policy, putting more than the minimum requirement. The more you fund it is the faster your cash value grows, plain and simple. And that's thanks to using compound interest. So a lot of people ask, what's compound interest? What's the difference between compound interest and simple interest? Using the rule of 72, all these things. Well, let's talk about it. Compound interest is very simple, but it's super important to have it for this strategy. It pretty much is a concept where your interest is growing interest on top of what you added to the principal. So you're going to be earning interest on your interest over the time, not just every year starting from zero. So this exponentially helps you grow your IULs, and it's such a powerful tool. And then also you have a rule of 72. Take your interest rate divided by 72. That's how long it takes your money to double. You have to understand how to use this when you're getting your right estimations. If you don't have it, you're not going to know how long it takes. For example, if your IUL is earning 6% interest annually, then 6 divided by 72 is what? Is 12. You know, every 12 years, your money is going to be doubling. And this compounding effect can create significant growth over time, especially for my younger crowd out there if you're starting earlier. Now, how do you specifically use the IUL to achieve that 0% tax bracket? It's very simple, but it's about using the cash value in your IULs to fund your tax-free retirement by taking tax-free loans. Most people take withdrawals on all their accounts, but taking tax-free loans from your IUL's cash value, it can help you access retirement income without paying the taxes. Now understand, with IULs, the strategy is designed to keep you in a 0% tax bracket, ensuring you don't face any income taxes on your money without taking regular withdrawals. In addition, your IULs, you want to make sure that you're combining it with something else. Maybe your Roth IRAs. And the reason why I love combining IULs and Roth IRAs, because a Roth IRA gets to grow tax-free and allows tax-free withdrawals during your retirement. And this idea pretty much, it gives you a mix. You're going to have a tax-deferred growth in your IULs, tax-free income from your Roth IRA, so you could access multiple sources of income in your retirement, all while saving below the taxable threshold. That's the key, because there's something out there called a MEC, a modified endowed contract, pretty much, which could get you out that tax threshold. Now, there are risks. So understand the pros, the cons. So some of the risk is it could be a powerful tool, your IULs, but you have to understand, like I said earlier, the cost of insurance could be significant, especially as you get older. So you want to have your policy pretty much started out so you could have it increasing, but then you could switch it to level. What that means is you're going to be structuring it so as you get older, those costs are going to lock in. That allows you to pretty much maximize your cash value. Otherwise, you could end up with a policy that's not growing as quickly as you would hope. And then number two, understand market performance. No, the performance plays a huge role, so you don't have a guaranteed amount. So it does offer you a floor. Your IULs have a floor. Zero is your hero. You never lose your money. But there's also a cap. So if a company has, say, a 14% cap, the market does 18 for the year, you're capped at 14. Meaning you won't be able to fully benefit from everything, but you're not taking any losses. And then lastly, if you don't structure this properly, and if you fail to overfund it, there's a huge risk that your policy collapse. Now, what does that mean? There's not enough value to provide for retirement. If you're not paying into it, you could actually have your policy lapse, and then it'll be null and void. So if it's done right, the IUL could provide, a huge benefit where you have your tax-free source of retirement income and leave a tax-free legacy. That's the big key. Not only do you have tax-free retirement, since it's insurance, you're leaving a legacy for your beneficiary. So the strategy is designed pretty much to help you keep as much of your wealth as possible by minimizing your taxes and then transferring your wealth to your beneficiary and your loved ones. I don't know what else you can say about that. You want to leave something. Most people want to leave a legacy. They end up leaving a liability. So you want to kind of have this where you could leverage it. You could leverage it so your money could grow. You can maximize the effectiveness of your IULs and achieve that goal of a 0% tax bracket. So I always talk about having supplemental income. I don't recommend having one thing. Have different things out there. Have a 401k, have your Social Security, have an IRA, have an insurance, have different kind of strategies, different kind of things to make that perfect bucket for retirement. So if you're interested in learning more, make sure, guys, that you like, follow, and subscribe to the channel. I go over a lot of your retirement strategies and making sure that you really understand how you can use it for yourself, folks. And make sure you check the description below, as you could get automatically approved on insurances for my business owners. I have, so you can get 6 figures and up to fund your business. And for those looking for another way to save, I have your health savings accounts, your HSAs in the description. Click on those links. That way you can get yourself and your financial journey started. And I'll see you next time. See you at the top.